Welcome everyone, this is Scramble from Emotionless Crypto Trading, and today we're continuing our video series of educational content with the head and shoulders pattern topic. Now this video is great for the ones looking to trade Forex, crypto, futures, stock market, right? So the pattern is the same everywhere. It's going to appear following the same rules in any type of trading you're doing. In today's video, we've got the theory part as well, the practical side for the head and shoulders pattern. So stay with us, because in the first part of the video, we've got the theory, second part is the practical side. We're also going to share with you where do we have the entry points, exit points, where do we put the stop losses, and this kind of things as well, how to use the head and shoulder pattern at the time it appears. So the first thing is it needs to be recognized, and the second thing, it needs to be used correctly. If you follow these two important elements, then you're going to succeed with the head and shoulder pattern and make money, have correct trades. Great, so in a nutshell, we're going to cover what is the head and shoulder pattern, rules, representation, what do we get out of this pattern, notes, the complete explanation, and then the charts. A head and shoulder pattern is a chart formation that resembles a baseline with three peaks. The outside two are closing high and the middle is highest. In technical analysis, a head and shoulder pattern describes a specific chart formation that predicts a bullish to bearish trend reversal. The head and shoulder pattern is believed to be one of the most reliable trend reversal patterns. It is one of the several top patterns that signal with varying degrees of accuracy that an upward trend is nearing its end. That means the head and shoulder pattern is great for the ones looking to short the market. The reversed head and shoulder pattern is great for the ones looking to long the market. So these are the conditions involved. Now, it forms pretty much from the price perspective. It rises to a peak and then subsequently declines back to the base of the prior up move. Then the price rises above the former peak to form the head, and then again declines back to the original base. Then finally the price rises again, but to the level of the first initial peak of the formation before declining back down to the base or neckline of chart patterns one more time. Now there are a few rules that definitely needs to be underlined, and we have to keep them in mind. A head and shoulder pattern is a chart formation that resembles a baseline with three peaks. The outside two are closing high and the middle one is the highest. A head and shoulder pattern describes a specific chart formation that predicts a bullish to bearish trend reversal, or if it's reversed head and shoulder, then it predicts a bearish to bullish trend reversal, exactly the opposite. The head and shoulder pattern is believed to be one of the most reliable trend reversal patterns. It's extremely efficient in my opinion during the activity of trading I had in different industries. I can assume that there is an average of 80% success rate at the time of a head and shoulder pattern for this specific one to be confirmed. Right? For example, in order to have a pattern confirmed, we definitely need to have a very high percentage out of the entire process of the pattern, the way it looks like, completed. So this one, it does have a very high process. The representation is just like that. That's the way it looks like. Just to make an idea with the head and shoulder pattern, what we're dealing with, until we go over the charts and we're going to see more details. Right, so we've got the uptrend, left shoulder, coming back to the neckline, head, get back to the neckline, right shoulder, below the neckline. Failing to get supported at the neckline, therefore, that's the time the large dumping comes in. What do we get out of a pattern like this? Well, after the long bullish trend, the price rises to a peak and subsequently declines to a form trough. The price rises again to form a second high substantially above the initial peak and declines again. Attention. The price rises a third time, but only to the level of the first peak before declining once more. So in a nutshell, as theory, this is what we get as a conclusion if you would have to underline the most important things. Now there are some notes that needs to be considered as well. The first and third peaks are shoulders, and the second peak forms the head. The line connecting the first and second throats is called the neckline. That is kind of the base of the neckline, which is also the base of the shoulders, kind of the support area for the shoulders. Head and shoulders pattern can also signal a downward trend is about to reverse into an upward trend. In this case, the stocks or any other prices which are reaching the 3 consecutive lows separated by temporary rallies, of these the second throat is the lowest, the head, and the first and the third are slightly shallower, the shoulders. The final rally after the third dip signals that the bearish trend has reversed and prices are likely to keep moving up. Now, the complete explanation in a nutshell, theoretically speaking, it's like all the charts, the ups and downs of the head and shoulders pattern tell a very specific story about a battle being waged between bulls and bears. The initial peak and subsequent decline represents the decline momentum of the prior bullish trend. Wanting to sustain the upward movement as long as possible, bulls rally push the price back up past the initial peak to reach a new high, and then we have the head under formation. At this point, it is still possible that bulls could reinstate their market dominance and continue the upward trend. However, once price declines a second time and reaches a point below the initial peak, it is clear that bears are gaining ground. Bulls try one more time to push price upward, but succeed only in hitting the lesser high reached in the initial peak. This failure to surpass the highest high signals the bulls' defeat and bears take over, driving the price downward and completing the reversal. Right, so let's just get over the charts, very important thing. And this is the first chart right here that I've selected, which is definitely pretty meaningful for us in order to draw the head and shoulder pattern. So I'm going to start with the starting point, of course, which is from here. It goes just like that, and right now we're about to form the left shoulder, just like that. This is the left shoulder. We're going towards to the head, just like that. We're pretty much coming down to this position right here, and we're starting to form the right shoulder, just like this. Now, considering this movement, there's two possibilities in this case. What we have during this representation is a comeback after touching the right shoulder. But this is very important because the comeback represents that the pattern is failing. We're also going to have a pattern and a chart that represents the confirmation of the pattern as it looks like. But you can see right here at the end, the pullbacks is pretty positive until here, and then we don't know what's happening from this point. But however, it is not crashing below at this point as it should, because normally the head and shoulder pattern from here, it goes just like that. And this way we have the completed head and shoulder. We've got A, which is left shoulder, B, it's the head, C, right shoulder. It falls down because the neckline is no longer supporting us, which is the blue line. Now you can see that the blue line in this case scenario is forming one of the most important parts for our chart, that is called support, and the market reacts there. Very nice, very, very correct. Now that do not exclude the ability for the market not to complete the pattern, because the fall down is eventually not going to happen, which is something that comes in at the end as a movement, right? So let's try to find out another pattern which is located right here. We're going to take a tool from here which is called head and shoulder, and this one right here. We're forming right now the left shoulder, which looks just like this. We're forming the head right now, we're forming the right shoulder, and we're crashing down towards. So this is the way it would look like on the charts on this representation right here. You can see that we're going up, forming the left shoulder, forming the head, going for the right shoulder, and then falling down. We've got this green line right here which forms the neck, and that's kind of the baseline of our left shoulder and right shoulder, exactly like it would look over here. That would be the baseline. As soon as we fall from the right shoulder, and we're not going to get supported like we got supported on the previous chart, as soon as we fall below this point, below that point, then we have an entry for short. We can short the market and take advantage of that. Now the big question is, what is going to be our target? Because the entry point is pretty simple. The entry is located right here below the neckline. Very simple. Because that is the confirmation that you have entered in the last part of the pattern after failing to get supported by the neckline, failing to establish a new high, and failing to confirm on the support side on everything that represented support before. Right? So what's happening is the bulls are getting out of the market, therefore the ones which are remaining are only the bears. And in this case scenario, you can short the market if you want to make money on this. So that's easy. The entry point is right there below the neckline. What do we use as target? Because it's pretty difficult. Well, what we use to go with a target is to measure from the neckline, from the base of the neckline, up to the highest point of the head, right? Which is located right here. So you have to measure this first and see that you've got 15% right there. You need to use a measure tool. Now, from your entry point, you can look 15% down in order to find an exit. And it would be somewhere here. As you can see, we've got 15% as well. And that would tell me to set a stop loss here. Sorry, not a stop loss. To set a limit order to sell my position right there. The stop loss is going to be set in a different place above the neckline, but we're going to talk about that very soon. Right, so this is where we set the limit order to close our position. And that is discovered from the difference between the baseline, neckline, and the distance till the top of the head. Right, so you have to measure that and put this distance right here from your entry point. Once you touch that, you put a limit order to close your trade. Very simple. Very, very nice. Great. Now, talking about the stop loss, well, that should be slightly above the neckline. Somewhere here. In this case scenario, somewhere here. That's where you put the stop loss. For a very small probability in case that the market has a false breakout of the last wing, which is number 4 here, and then it comes back within the channel and the head and shoulder is no longer forming. Right? That's why your stop loss is going to get triggered and you're not going to lose. In case you find support here back again and it spikes, then we do not have a head and shoulder. So the only time we have a head and shoulder is if it breaks the neckline and crashes down. But you have to predict this head and shoulder and you have to act earlier than the pattern would get confirmed. Because if you wait to get confirmed, you will be somewhere here down at the end of the pattern and nothing would remain on the table to profit from. So you have to act while there is only one probability that has a high percentage, about 80%, for the market to fall down after failing the neckline to get supported. And then of course the 20% remains as a probability for the market to have a false breakout below the neckline and then come back. But again, you're betting 80% against 20, which is very good. Great. Now, in a nutshell, this is the way it looks like. This is the way we would have to use the head and shoulder and we would have to deal with it. Very important pattern because it teaches us how to handle the market. There is another thing right here as well that I wanted to talk about, and this pretty much explains us exactly what I just said earlier than this. the pattern high is the starting point of the neckline, exactly what I just said, until the head. So the profits you would have as a target is exactly the same measure like the pattern high. And this representation is telling us that as soon as we enter here, this is the point we have to enter to short the market with the stop loss here. We're aiming the market is going down. We measure from the neckline till the head what is the distance, and we put that distance right here. So once we got the target, we put a limit order to be sold automatically. We don't even have to deal with the market anymore. If you achieve that, it's extremely great. Otherwise, please use alarms here, 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 and get some notifications on your emails. So therefore you can look at the charts in the way they are structured and organized, because sometimes the markets find support here, kind of in the middle of the way till your target, in the middle of the process to your target. So you have accumulated only 50% of your target, which could be 5% profit, 6%, 2%, 1% profit. It depends on the way the charts are looking, because the volume needs to increase pretty heavily after the neckline crash for the bearish side. If that happens, then it's great, because there are high probabilities for the market to continue down and for you to touch the target. Great. So the reversed head and shoulder, the inverse head and shoulder looks something like this. Exactly in the opposite way of the normal head and shoulder. But the only thing here is it just breaks above the neckline, and then you have to go long with the order. It's kind of the only thing that remains different. In a nutshell, this is pretty much all about what we have to know in order to get started to use head and shoulder pattern from the theory perspective, usability, what is great out of it, what do we find out, where do we have to entry, what are the last parts of the head and shoulder pattern, and where do we have to use the stop loss, including the target. If you manage these things correctly, then of course the only thing that remains is to make profits, and that is the thing that it will gonna happen. Great, so this is pretty much all about. Thank you so much for watching. Feel free to subscribe to my YouTube channel if you wanna keep in touch and stay up with the latest videos like this. We're covering a lot of the things which are helping people to trade better, to develop their skills, and of course we do technical analysis videos about different currencies out there in order to show people details of the market. Right, so feel free to share your opinion as well in the comments area. Hit that like button, and then after you're subscribed, you got that little bell. Make sure you click on that, so that way you never miss any of my updates. YouTube is going to let you know about it. If you need coaching, there's the link in the description area for one-on-one coaching. That's kind of all about today's video presentation. Thank you so much for watching. Talk to you soon.